Hello. Indian government bond yields declined for the first time in March after 7 consecutive months of relentless increase. After revisiting its previous peak of 7.80% in early March, the benchmark 10-year government bond yield trended lower amid emergence of value buying, softening in global bond yields in the aftermath of prospects of trade war. Other factors contributed to softening in bond yields in the first half of March included softening in consumer inflation for February, proactive liquidity injections by the RBI, and position build-up by market participants at attractive yields. However, bond market participants were positively surprised towards the end of the month when the government not only reduced the total borrowing by 50,000 crore rupees but also cut the borrowing plan for the first half to 2.9 trillion rupees. It translated to an average auction size of 12,000 crore rupees per week against markets' expectations of 18,000 crore rupees per week. Apart from this, sensing the somber mood of the bond market participants, the government decided to reduce the supply of 10 to 14-year bucket and increase the potential supply of shorter dated assets, which were preferred by market participants, especially banks. This positive development resulted in a huge improvement in sentiment and resulted in around 30 basis point decline in 10-year government bond yield to around 7.33% on March 27th. The Reserve Bank of India also chipped in with some good news for the bond market. In early April, it allowed banks to amortize their mark-to-market losses on their G-Sec portfolio over 4 quarters starting April 1st, 2018. This also resulted in further improvement in sentiment. Not stopping there, the RBI-led MPC gave a dovish guidance in their latest Monetary Policy Committee meeting on April 5th and reduced their inflation expectations for the first half and the full year. Bond market participants interpreted this as no hike in 2018 and drove the benchmark 10-year bond yield lower by around 15 basis points to around 7.15% on April 6th. Where do we go from here? We believe that the major issue of demand-supply imbalance has been addressed. With adequate liquidity and softer inflation outlook, bond yield should trend lower from here in the near term as market positioning continues to remain light. We expect the benchmark 10-year yield to trend towards 6.75% in the medium term. We recommend investors to focus on funds with high-quality assets and average maturity between 2 to 5 years. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.